Welcome back to Variable Income Mastery. We've covered a lot of ground. You understand that variable income is an opportunity. You've got your 3-account system set up and you've built a floor budget that works even in your worst months. But let's be honest, even with the best planning, there will still be times when your expenses and your income just don't line up perfectly. Maybe you have 3 slow months in a row instead of 2. Maybe an unexpected expense hits during a slow period. Maybe your car breaks down the same week your paycheck is smaller than expected. This is where smart credit management comes in. And I want to emphasize the word smart. We're not talking about racking up credit card debt or getting trapped into payday loans. We're talking about having low-cost credit available as a bridge between your income and your expenses. By the end of this module, you'll know exactly what types of credit to have available, how to get approved for them, and most importantly, how to use them strategically without falling into debt traps. So, let's dive in. Smart borrowing for variable income. First, let's talk about why having access to credit is so important when your income varies. With steady income, you can predict pretty accurately what your cash flow will look like from one month to the next. If an unexpected expense comes up, you know exactly when you'll have the money to pay for it. With variable income, you might know that you'll have the money to pay for that unexpected expense, but you might not know exactly when. Maybe you know that your busy season starts in 2 months, and you'll definitely have the money, but right now, during your slow season, you might be short. That's where smart credit comes in. You're not borrowing money because you can't afford something. You're borrowing money because of timing. You can afford it, but just not right this moment. This is completely different from the kind of borrowing that gets people into trouble. You're not borrowing to buy things you can't afford. You're borrowing to manage the cash flow timing. Home equity lines of credit. If you own a home equity line of credit or a HELOC is probably your best borrowing option. Here's how a HELOC works. Your bank looks at how much your house is worth and how much you still owe on your mortgage. The difference is your equity. They'll let you borrow against some of that equity, usually up to 80% of your home's value, minus what you owe. So if your house is worth $200,000 and you owe $100,000 on it, you have $100,000 in equity. A HELOC might let you borrow up to $60,000. That's 80% of $200,000, which is $160,000 minus the $100,000 that you still owe on the mortgage. So, why is a HELOC so good for variable income workers? First, the interest rate is usually tied to the prime rate, which means it's much lower than credit cards. Depending on when you're watching this, HELOC rates are typically between 6 and 9%, while credit cards are often 24% or higher. Second, you only pay interest on what you actually borrow. So, if you have a $60,000 HELOC, but you only use $2,000 of it, you only pay interest on the $2,000. Third, it's a line of credit, not a loan. That means you can borrow money, pay it back, and borrow it again without having to reapply. Perfect for managing variable income. Let me show you what this looks like with real numbers. Let's say Sarah needs to borrow $1,500 during a slow month to cover her expenses. Her HELOC has a 7% annual interest rate. Monthly interest rate, 7% divided by 12, equals 0.58% interest on $1,500 for 1 month. 1,500 times 0.85% equals $8.70. Sarah pays less than $9 in interest to borrow $1,500 for 1 month. When her next good paycheck comes in 2 months later, she pays back the $1,500. Her total interest cost about $17. Compare that to a payday loan, which might charge 15% for 2 weeks. On the same $1,500, that would be $225 in fees, plus another $225 if she needed to roll it over for another 2 weeks. HELOC, $17 in interest. Payday loan, $450 in fees. The HELOC saves Sarah over $400. That's real money. Personal lines of credit. If you don't own a home or if you don't have enough equity for a HELOC, a personal line of credit is probably your next best option. Personal lines of credit work similarly to HELOCs, but they're not secured by your house. Because there's no collateral, the interest rates are higher, typically between 8 and 15%, but they're still much better than credit cards. Personal lines of credit are harder to get than HELOCs because the bank doesn't have your house as security. They're going to look more carefully at your income and credit score. This is where having a floor budget becomes really important. When you apply for a personal line of credit, you can show the bank your floor budget and explain that even in your worst months, you can make the minimum payments. Banks are much more comfortable lending to someone who has a clear plan for how they'll pay the money back, even if their income varies. Some banks that offer personal lines of credit include Wells Fargo, PNC, US Bank, and many others. Credit cards should be your last resort for borrowing, not your first choice. Why? The interest rates, mostly, are brutal. The average credit card charges about 24% annual interest. That's more than double what you'll pay on a HELOC or a personal line of credit. But here's the thing, you should still have credit cards. Not to use necessarily regularly, but to have available in emergencies. So, which credit cards should you have? Look for cards with no annual fee and low interest rates. You're not looking for rewards or cash back, you're looking for emergency access to credit at the lowest possible cost. Some good options right now are the Citi Simplicity card, which often has a 0% introductory rate. The Chase Slate Edge has a low ongoing interest rate. And it's worth checking around on the credit union credit cards, which sometimes have lower rates than some of the banks. Keep these cards in a drawer, don't carry them with you, don't use them for regular purchases. They're there for true emergencies if you don't have a HELOC or a personal line of credit, or if they're not quite enough. The borrowing hierarchy. Here's your borrowing hierarchy. Use these options in this order. 1. HELOC if you're a homeowner with equity. 2. Personal line of credit. 3. Credit cards with promotional 0% rates. 4. Regular credit cards. 5. Personal loans. The fixed payments are harder to manage with variable income. And 6. Never ever use payday loans, title loans, or rent to anything unless there are no other options available. The higher up the list, the lower your interest costs will be. The math of short-term borrowing. A lot of people are scared of borrowing money because they don't understand what it actually costs. Let me show you the real math so that you can make informed decisions. Let's use a common scenario. You need to borrow $1,000 and you can pay it back in 3 months. Here's what that costs with different types of credit. A HELOC at 7% annual rate. Monthly rate is 7% divided by 12, which is 0.583% a month. So in your first month, that $1,000 will be $5.83 in interest. In month 2, it'll be $5.83 in interest. In month 3, it'll be $5.83 in interest. Total interest costs $17.49. A personal line of credit at 12% annual rate, meaning the monthly rate is 12% divided by 12, which is 1% per month. Total interest for 3 months will be 1 times 1% times 3, which will be $30. On a credit card at 24% annual rate, the monthly rate is 24% divided by 12, 2% interest a month. Total interest for 3 months is $1,000 times 2% times 3, $60 to borrow that $1,000. And a payday loan at 400% annual rate, the 2-week rate is 400% divided by 26, 15.38%, cost for 6 2-week periods, $1,000 times 15.38% times 6 equals $923, almost as much as the amount you're borrowing. Look at that last number. In this case, the HELOC costs $17. The payday loan costs $923. That's 54 times more expensive. This is why having good credit options set up before you need them is so important. When you're in a cash crunch and you don't have time to shop around or apply for new credit, you'll probably take whatever's available, and what's available might be really expensive. Break-even analysis. Here's something most people don't think about. Sometimes borrowing money is actually cheaper than trying to cut your budget. Let's say Sarah is having a slow month and she's $200 short of her floor budget. She has a few options. Option 1, cut $200 from her budget. Maybe she stops buying groceries for a week and eats nothing but rice and beans. Maybe she skips her car insurance payment and risks driving uninsured. Option 2, borrow $200 on her HELOC at 7% and pay it back in 2 months. The borrowing cost? $200 times 7% divided by 12 times 2 months equals about $2.30. So Sarah can either compromise her nutrition and risk legal problems by skipping insurance, or she can pay $2.30 to maintain her normal budget. When you put it that way, borrowing $200 for 2 months is obviously the better choice. This is what I mean by strategic borrowing. You're not borrowing because you're financially irresponsible. You're borrowing because it's the most cost-effective way to manage temporary cash flow problems. Payment strategies to minimize interest. When you do borrow money, how you pay it back makes a big difference in what it costs you. Strategy 1, pay it back as soon as possible. Don't wait for your regular monthly payment. As soon as you have surplus income, pay down the borrowed amount. Every day you pay early saves you money on interest. Strategy number 2, make more than the minimum payment. If your HELOC has a $50 minimum payment but you borrowed $1,000, don't just pay $50, pay back as much as you can afford each month. Strategy 3, pay back principal, not just interest. Some lines of credit let you make interest-only payments. Don't do this unless you absolutely have to. Always pay down the principal balance when you can. Let's look at an example. Sarah borrows $500 on her HELOC in January when income is slow. In March, she gets a good paycheck and she has 2 choices. Choice 1, make the minimum payment of about $25 per month. Or choice 2, Pay back the full $500 as soon as the March paycheck hits. With Choice 1, she'll pay interest for many months until the balance is finally paid off. With Choice 2, she pays interest for only 2 months, saving significant money. The key insight: treat borrowed money like it's on fire. Pay it back as quickly as you possibly can. Building credit for variable income. When you apply for credit and your income varies dramatically from month to month, you need to know how to present that information to lenders. Don't just tell them your worst month or your best month. Give them your annual income and explain the pattern. Here's how Sarah would present her income to a lender. My annual income is approximately $65,000. I work as a diesel mechanic and my income varies seasonally. During busy season, which runs from March through September, I typically earn $3,500 to $4,100 per month. During the slow season, which runs from October through February, I typically earn $1,800 to $2,100 per month. This tells the lender 3 important things. 1, her total annual income is solid. 2, the variation is predictable, not random. And 3, she understands her own income pattern. This is much better than saying, well, sometimes I make a lot and sometimes I don't make very much at all. Documentation strategies. Lenders want to see proof of income, but traditional pay stubs don't tell the whole story when your income varies. Here's what documentation to provide. Tax returns. These show your annual income over multiple years and prove that your total earnings are consistent, even if your monthly amounts vary. Bank statements. These show your actual cash flow pattern. Bring 12 months of statements so the lender can see the seasonal pattern. Employment verification. A letter from your employer explaining that your income varies due to the nature of the work, but that you're a reliable employee in good standing. Contracts or work agreements. If you do contract work, bring copies of recent contracts to show that you have ongoing work relationships. The key is to tell a complete story about your income, not just show random pay stubs. Building credit history before you need it. The time to apply for credit is when you don't need it, not when you do. When you're having good months and your bank accounts look healthy, that's when you should be applying for HELOCs and personal lines of credit. Lenders are much more likely to say yes when you look financially stable. If you wait until you're having cash flow problems to apply for credit, you'll look desperate to the lender. Your bank balances will be low, your debt-to-income ratio might look scary, and you're more likely to get rejected or offered worse terms. Here's Sarah's strategy. During her best income month of the year, when her checking account balance is high and she just got a great paycheck, she applies for her HELOC. She doesn't need it right then, but she knows that she'll need it in 6 months during the slow season. The application process takes a few weeks, so by the time it's approved and ready to use, she's heading into her slow season. Perfect timing. Improving debt-to-income ratios with irregular earnings. One challenge with variable income is that your debt-to-income ratio can look very different depending on which month the lender looks at. If they look at your income during a slow month, your debt-to-income ratio might look too high. If they look during a good month, it might look fine. Here's how to manage this. First, apply for credit during or right after your good months, when your recent pay stubs show higher income. Second, provide annual income information to give the lender a complete picture. Third, pay down existing debt before applying for new credit. If you have credit card balances or other monthly payments, paying those down will improve your debt-to-income ratio regardless of which month they look at. Fourth, consider timing. If you know you'll have 3 months of good income starting in May, apply for credit in June or July, not in February when you're in the middle of the slow season. Credit monitoring and management. When your income varies, you need to pay extra attention to your credit score and credit report. Here's why. Lenders are already a little nervous about variable income. If your credit score drops or there are problems on your credit report, you might get rejected for credit that you would have qualified for with steady income. Set up free credit monitoring through Credit Karma, Credit Sesame, or your bank. Check your credit score monthly and your full credit report at least every year. Pay special attention to on-time payments. Never ever be late on credit card or loan payments. Credit utilization, keeping credit card balances low, below 30% of your limits. Credit mix, having different types of credit like a mortgage, car loan, and credit card can actually help your score. And length of the credit history. Don't close old credit cards unless they have annual fees. The goal is to make your credit profile so strong that lenders focus on that instead of worrying about your variable income. Building relationships with local banks. Here's something that can make a huge difference. Building relationships with local banks or credit unions before you need to borrow money. Big national banks make lending decisions based on algorithms and credit scores. Local banks and credit unions may have more flexibility in making decisions based on relationships and understanding your situation. Opening a checking account at a local credit union or community bank and having them for years prior to applying for a loan with them might give you some options that you wouldn't otherwise have. Wrap up. Let's recap what we've covered in this crucial module. Now you understand why access to credit is essential for managing variable income, not because you can't afford things, but because of timing mismatches between your income and expenses. You know the hierarchy of borrowing options. HELOCs are best for homeowners. Personal lines of credit are next best. Credit cards are a last resort. You understand the real math of borrowing costs and why payday loans and title loans are financial disasters. You've learned how to present your variable income to lenders in a way that shows stability rather than chaos, and you understand the importance of building credit relationships before you need them. Most importantly, you understand that strategic borrowing isn't a sign of financial weakness. It's a tool for managing cash flow timing when your income varies. And here's your action item for this module. If you don't already have them, start the application process for a HELOC if you're a homeowner or a personal line of credit if you're not. Do this during a good income month when your financial picture looks strongest. And in Module 5, we're going to get industry specific. Different types of variable income work have different challenges and opportunities. Whether you're in healthcare, skilled trades, or service industries, we'll cover strategies tailored to your specific situation. The credit foundation you're building now will serve you well regardless of your industry. But in the next module, we'll fine-tune these strategies for your specific type of work. I'll see you in Module 5.